Hello, everybody. Welcome everybody to our webinar today. Thank you all for joining us. It's going to be a really good, very informative webinar. I'm super excited about this one. We got a lot of great information. My name is Andrew Farrell. I am Patelco's financial well-being educator. I want to thank you all for joining us for our HELOC 101 webinar this evening. Before we get started, I have just got a little bit of housekeeping kind of stuff I wanted to share with everyone who's joining us today. First and foremost, we have a chat function. If you guys can use your chat to just share your opinions, your thoughts, if you have any suggestions or anything like that, feel free to use the chat for that. Just make sure that we all have our settings shifted from hosts and panelists to everybody. That way everyone can see your thoughts, your opinions, and we can all kind of share in the conversation. At the bottom of the toolbar, we also have the Q&A feature. Q&A is what we're going to use for questions. So if you have any questions that you want our mortgage representatives to answer, go ahead and put those in the Q&A. We are going to have a little bit of designated time at the end of the presentation today to do some Q&A. Depending on the amount of questions that we receive, we might not be able to get to all of them, but I do have an email address and a phone number that I can send to anybody who does not have their question answered on today's webinar. We have a mortgage lending team that can answer all of your questions from there. So we will make sure that we get your answers or your questions answered in some capacity. We just might not have time to do everyone's on this evening's webinar, but we will be saving a Q&A portion at the end. So questions you have, just make sure you dump them in the Q&A. At the end of this webinar presentation, we are going to have a recording for this, and everybody who's emailed will be receiving an emailed video link with the recording of the presentation. It'll be a YouTube link that's probably going to be sent out sometime beginning of next week. So keep your eyes peeled for that if you'd like to go back and watch any of this video that we have and pick up on those tidbits. And we also are going to be raffling off 3 Amazon gift cards. So keep your eyes peeled for that as well. If you receive an email, we'll send those out on Friday, so keep your eyes peeled on Friday. And if you get an email from Patelco Webinars that says, congratulations, you've won an Amazon gift card, I promise it's not a scam. It's actually from us. It's just a thank you for registering and for tuning into our webinars. So this evening's webinar is HELOC 101, What to Know Before You Borrow. So home equity can be a very powerful financial tool for managing big expenses, managing future plans, increasing your cash flow, or just to have an extra safety net. So today we are going to offer you a clear, practical walkthrough of how a HELOC works and what to consider as you explore your options. We will talk about draw periods, repayment, HELOC versus a home equity loan, as well as some Patelco-specific HELOC features. And to help us with this, we have got 2 excellent Patelco mortgage reps with us. Tonight we are joined by John Takayama. So John is our internal home loan sales manager. He's an experienced leader in mortgage lending and call center operations, business optimization. He has tons of product knowledge, and he leads our consumer home lending teams that help turn complex financing into confident, concrete decisions for our members. And we are also joined this evening by Andy Hitesman. So Andy is an internal home loan consultant with us. He has got over 10 years of experience as a Patelco-specific home loan consultant, so he knows our products inside and out. He always brings a fun and energetic spirit to every consultation. So everybody, please help me in welcoming John Takayama and Andy Hitesman.
Hey everyone, I hope you're having a good day so far. I'm happy to be here with you to go over Patelco's home equity products as a whole, specifically diving into the HELOCs today. Like Andrew said, my name is Andy Hitesman. I've been with the credit union for almost 11 years, strictly as a home loan consultant. And I'm happy to go through the home equity line of credit product with you today.
Hello, everyone. I'm John Takayama. I'm the manager of the internal home loan consultants here at Patelco. We're excited to be here today and talk to you guys about HELOCs. We have a great presentation set up for you and also some videos to keep things entertaining. And we'll start off with a quick intro to what is a HELOC.
Ever wondered how you could tap into your home's value without moving a single brick? Meet the Home Equity Line of Credit, or HELOC, if you like your financial terms flexible and snappy. Think of a HELOC as a magic pool of money just waiting for you. It's based on the value your home's built up equity. Instead of getting a lump sum, you get a credit line, kind of like a giant credit card, but your house is holding the reins. Here's how it works. You apply for a HELOC. The lender checks your home's value, crunches some numbers, and abracadabra, the credit line is set. You borrow what you need whenever you need it for the next 10 years and pay interest only on the amount you use. Then, for the remaining 15 years, any outstanding balance becomes monthly principal and interest payments. Why do people love HELOCs? Flexibility, big repair looming, consolidating high-interest credit card debt, planning a dream kitchen, covering tuition? A HELOC lets you pay for it with your home's equity. Plus, you only pay interest on what you use, not the whole line, and that keeps things friendly with your wallet. So, recap time. HELOC equals access to your home's equity, flexible borrowing, and a helpful hand for life's big expenses. That's what a home equity line of credit is, all wrapped up and ready for you to take advantage of.
All right. So first of all, how about that video? Amazing. I mean, I couldn't have done it any better myself. I mean, John, awesome. So the home equity line of credit, you'll hear it a lot from, different, lenders saying HELOC. That's the acronym that would be used, home equity line of credit. And it's a revolving account. So you're approved for a specific limit, which enables you to draw from the funds as needed. So you do not have any minimum draw requirement. You have this open revolving equity line to draw from as needed, and you're only billed based on what you use. So the revolving nature is going to be beneficial to be able to, access portions of the equity line if you don't need it all at once. As you pay it down, more and more becomes available. So it really gives you the power to understand what you're using, what you're spending, and control what your monthly payments are going to be.
Just like a credit card.
Very similar, very similar.
All right. Let's see. One of the things, I think I really appreciate about HELOCs is that, well, I got my first mortgage a few years ago and I have a great interest rate.
Yeah.
And, like many people that have, let's say, a 3, 4, sometimes maybe even a 2% first mortgage interest rate, you don't want to touch that, but you still want to tap into the equity of your home. So one of the great advantages of a HELOC is that, you leave your first untouched, and then you just utilize the equity that's remaining.
And it makes sense because, like you're mentioning, if you had a first mortgage originated, let's say in 2019, 20, 21, you have a great rate on your first, you don't want to take cash out of the property affecting your first mortgage. Being able to still access the equity that's been built up in your home, but through a new home equity line of credit, leave your first mortgage untouched. That's just going to be, for a majority of people nowadays, the way to go in regards to tapping into the home's equity.
Here's some common uses. Most frequent common use that I've been seeing lately is really consolidating debt.
Yeah.
A lot of people, have credit cards. As you know, credit cards are a lot higher interest rates than a HELOC, right? I mean, you're talking credit card rates 20% or higher even. So having a HELOC and using your home equity as collateral really helps with those interest rates. Along with that, there's higher interest personal loans, also a much higher interest rate than a HELOC. So consolidating those debts into a home equity line of credit is often the smart choice for many of our members.
Yeah, and I see a lot of applications coming in, just over the years for people, consolidating credit cards, but they had 0% interest on their credit card, transferred a balance, whatever they needed to do to help alleviate some payments. But, a year has gone by and the credit card interest rate is going to jump. So, it makes sense, to be able to take advantage of lower interest rates on, let's say, a credit card for a certain amount of time, but that's always going to come due. So then I see, applications coming in from our membership looking to consolidate those cards that are, coming to the maturation of, the promotional 0% or a low interest credit card to then consolidate with the line of credit.
Yeah, it's all about financial planning and timing.
Correct.
But having a HELOC as an option is a great financial option.
Absolutely. Some other things, that, I see, and it kind of goes away from debt consolidation, let's say, but for future use. To be able to have a line of credit there as a rainy day fund, let's say emergency fund, where you have, urgent home repairs, you have, your water heater goes out, you need to fix a portion of your roof, you have medical expenses that were unexpected, or things that you can plan for, college education, still very expensive, so you have these, tuition, you have books, you have, a variety of different things that come with that, where it's nice to be able to have this set up before you actually need it, because you're only billed on what you use. So, to be able to, potentially use, say, $10,000 for, the food and beverage and lodging, everything for college education that comes with that, then you're billed based on that 10,000. So it enables you to be able to better situate yourself for short-term and long-term needs.
For me, I might, buy my midlife crisis motorcycle at one point. It's nice to have an instant.
You're right there. You're right there. I've got about 30 years to go until my midlife crisis, but we'll see how that comes about.
All right. Another important key to being pre-qualified and having that HELOC already set and ready to go is, home repairs. You never know when that leaky roof might suddenly appear. Or maybe you're off on vacation someplace or just traveling and see a wonderful, vacation home opportunity. It's nice to know that you might just have that down payment ready to go.
Yeah, it's there. Responsible spending, though. Some things that we kind of already touched on as well, just let's say upgrades, bathroom, kitchen. You buy a property and you don't really like the backyard. So, a couple years go by, build up the equity in the home, and you decide to, not necessarily put in a pool, but I've seen people do that. Just, new sod, new hedges, just a variety of different uses, because you really control what you're utilizing out of the equity line. So different members have different needs, but it is nice to be able to not have to dip into your savings or, take a loan out on your 401k to be able to have the tool of the home equity line. It just makes going through that process of, construction or what have you for home improvements that much easier.
I'm telling you about it. My wife is raging all about granite countertops. We need granite countertops.
Not cheap.
Definitely not cheap. One of the great things about having a HELOC for specific home improvement use is that in many situations, the interest could be tax deductible, but you really need to check with a CPA or tax professional on that if that situation applies to you. I was fortunate and it applied to me, but each situation is unique and different. So be sure you consult with your tax professional before you write off any of your HELOC interest that was used specifically for home improvements.
Exactly.
All right, we have another video for you.
Imagine unlocking the potential hiding in your own home, turning its value into possibilities through a home equity line of credit, or HELOC. It's more than just a financial tool. It's a key to new experiences and opportunities. First, let's start with the essentials. Many use HELOCs for big improvements, like remodeling a dated kitchen or adding an outdoor deck, upgrades that make your home more comfortable and boost its value. Others tap into their HELOC to pay off high-interest credit card debts, simplifying life with one manageable payment. But HELOCs are not just about the practical. Imagine finally taking that once-in-a-lifetime family vacation or funding that dream wedding. Some use their line of credit to start a small business, cover college tuition costs and expenses, or create magical memories that would have stayed on the wish list without a little financial flexibility. Of course, with great opportunity comes responsibility. Using your HELOC wisely means understanding your limits, keeping your goals clear, and always planning your repayment. Used thoughtfully, a HELOC can help turn ordinary equity into extraordinary life-changing moments. Whether it's for upgrades, adventures, or a fresh start, your home's value can open doors to the future you've been dreaming about.
All right. So for the home equity line of credit, we like to call them two different periods that you have. The draw period, like we've been discussing, that is a 10-year period where you have access to draw and pay down the equity line as needed. So you have that available limit. You draw 10,000 for a new kitchen, you start to pay it back. But the minimum payment due during that draw period is interest only. But because there's no prepayment penalty, a lot of our members, and we do suggest this if possible, is to pay additional towards your principal balance. As you pay down the principal, more and more of that equity line becomes available to use. So you can draw and pay down as needed during those 10 years, and you really control, have a better understanding of what your payment will be based on what you use. So that's going to be a big, where all the utilization comes into place during those first 10 years. And 10 years is a long time. You could get the HELOC and just say, I'm consolidating debt. I have $50,000 in credit cards that I need to consolidate. But, say you paid all that back in 5 years, you have no balance. The line of credit remains open unless you close it. And, you might have needs in the future for it. You could, like John was saying, a second home, vacation home, you could have other home improvements. The granite goes out of style and you go into courts or, whatever the hot thing, a couple years down the line, but it does have that flexibility, which is nice during the first 10 years.
So I could draw on this HELOC for 10 years.
That's correct.
But what if I want to draw it for like 11 or 12 years? What are my options?
Well, there is no option. It says 10 years. But what I see a lot and what I, hear people calling about is about their equity line coming to an end as far as their draw period is concerned. So they're on year 8, they're on year 9, they have no balance, let's say. They call in and say, I'd like the flexibility of the equity line. I'm coming to the end of my 10 years. I know there's no longer than 10 years. What can I do? My suggestion to them is we can always put in a new home equity application for the amount that they're seeking. It could be different, could be the same as what they had currently. We would then, if they had a balance paid off in this scenario, they have no balance, we would close the existing equity line, replace it with a new one, and the 10-year draw period starts over again. So it does give you that tool again to be able to reset your draw period and go through the qualification process again. We'll re-verify income, equity, a variety of different things, but that would then enable you to tap into the funds again for an additional 10 years on your new product.
So what you're saying here is, before the 10 years or even maybe a year or two after the 10 years, I could reapply for another HELOC and kind of reset the clock over again.
Correct. There's no limitations. There's no minimum amount of time you need to keep it open initially. So you can go ahead and, reapply for new equity line, potentially with a higher limit, as your equity in your home builds and you have more projects that you're looking to do, you can go and apply for new equity line and we'll go through the approval process to get another one set up for you.
Let's talk about the second period, the 15 years. What's going on there?
So the repayment period, that's when you are forced to pay back principal and interest. You can always pay principal during the draw period, but at the end of the 10 years, if you, let's say, have no balance, the equity line will close. The lien will be released on the property and, your business as far as the HELOC with Patelco is concerned is no longer. If you do have a balance, let's say you have a balance of $50,000, you will no longer have access to draw from those funds because the 10 years will have passed and you'll be in the repayment period. At that point, we'll bill you principal and interest amortized over those 15 years. So you'll be, billed principal and interest, but there's no prepayment penalty again. So you can pay off that, equity line, whatever the balance is, in portions. You can apply chunks to principal, you can pay it off all at once, or you can just make the principal and interest payment. That would be amortized over 15 years. So the total term is 25 years. Rarely I see a member keep it open for the full 25 years because, like we discussed, they like the flexibility. They've, let's say, moved, they sold the property, so the equity line is already paid and closed. There's a variety of different reasons I would say the full 25 is not applicable to most members, but it's definitely there for the total term, 10-year draw, 15-year repayment.
What I really like about the Patelco HELOC, unlike a lot of other lenders, there's no annual fee during the 10-year draw period.
Yeah.
So it's literally, free to keep open and have those funds accessible to you through those 10 years.
Yeah, it doesn't hurt to have the equity line open, especially if you have no balance, let's say, because you're not paying a annual fee, like you're saying, or like a credit card. You have a fee that you're have to pay every single year, even though you might not be utilizing that service.
So key things to know about is that HELOCs are based on the United States prime rate, which can go up and can go down. We don't have control over the U.S. prime rate, but the HELOC base rate is based on that. So one of the key features is that, for the first 10 years, like we mentioned, you only pay interest on what you use. Now, for us, we're very fortunate that currently we do have a 5.49 introductory promo rate, but that's only if you apply before March 31st.
Less than a week.
Yeah, and that promo rate of 5.49, which is below the U.S. prime rate, will be good for the first 6 payments, and then it's going to go back to your qualified rate. Now, once it is back at your qualified rate, we also, for Patelco members, have an eligible auto payment discount of 0.5%. That means that whatever your qualifying rate is, if you have automatic payments set up from a Patelco checking account, which has monthly deposits of $500 or more, you can get 0.5% off your rate.
That's big. If you carry balance, you do a lot of home improvement projects, $200,000, $250,000, 0.5%, to set up auto pay, which is, something that a lot of our members already take advantage of. And then, if you're utilizing the credit union as far as deposits coming in, to be able to satisfy both of those conditions to get that discount, it's, something that we suggest to do just to help alleviate, a large monthly payment, based on the standard qualifying rate.
Absolutely. And you can also set up automatic payments to pay, some into that principal balance there.
All
right, let's go back into more about two different kinds of home equity products we have.
Imagine standing at a crossroads, faced with 2 choices, one blue pill and one red. Each offers a different path if you want to borrow against your home's equity. The blue pill reveals the home equity loan. The red pill leads to the home equity line of credit, or HELOC. Choosing between them shapes your financial journey. Swallow the blue pill, and you step into a world of certainty. The home equity loan hands you a lump sum up front, locked in with a fixed interest rate. Payments are predictable, same amount every month until the loan is paid off. This route is perfect if you know exactly how much you need for a big project or expense. The advantage? Stability. You get all the money at once, with no surprises on your monthly bill. But the trade-off? You start paying interest on the total amount right away, even if you don't use it all. Take the red pill, and you enter a world of flexibility. The HELOC lets you borrow what you need, when you need it, up to a set credit limit. Interest rates are usually variable, so your payments can change. This path works well if your expenses are spread out or unpredictable, like ongoing renovations or tuition payments. The big advantage is you only pay interest on what you actually use. The downside? It's harder to budget with payments that can rise when you borrow more and a rate that may possibly change. The blue pill brings control and peace of mind. The red pill offers adaptability and ongoing access to funds as you need it. The choice is yours. Armed with this knowledge, you decide which way to go, knowing that either path can help you unlock your home's power when you choose wisely.
All right. So the 2 home equity products that that video kind of went over is our home equity loan versus the HELOC. We've been really diving into the HELOC thus far, so we wanted to kind of bring in another option as far as tapping into the equity in your property. So for the equity loan, how it works, I'll go over the terms in 1 second, but how it works is it's a one-time loan. So it's more of a standard second mortgage where you take all the funds at once and you immediately start making principal and interest payments. So, the terms are 10, 15, and 20 years. They have fixed interest rates. So that's going to be, a key difference from the HELOC, and taking all the funds at once is a key difference. What I would say as far as members applying with Patelco, the differences for needs for the members, the home equity loan is, because it's a one-time loan, people aren't really using it for, let's say, home improvements that they don't know exactly how much they're going to need, how much it's going to cost. Because the last thing that you want is to take a lump sum out of the equity in your home, and you're still going through hiring a contractor. They're still going through the plans. They're scheduled 6 weeks out. There's so many different things where you have this large sum of money sitting in, your checking or savings account, and you're paying interest on it when you're not utilizing the fund. So I would say a lot of times it just doesn't make as much sense for that type of home improvement project to go with the home equity loan.
Yeah, I've dealt with a lot of contractors, unfortunately. And let me tell you, when they give me an estimate, it's an estimate.
And it's on their time.
Yes, absolutely. So, having a home equity loan fixed for a certain period of time, 10, 15, or 20 years, is nice for certain situations, right? The downside is, once you get those funds, you're paying principal and interest every single month, or whether you use those funds or you don't.
Yeah, so that's why I would say the majority of those applications that are coming in are for strictly debt consolidation, or for understanding I need $10,000 for this specific need. I borrowed money from my parents. I need it for, I'm buying this, certain product, and I know it only costs this. But for not knowing exactly what the funds are going to be utilized for and how much, the debt consolidation route for the home equity loan is where people go. Like John was talking about, 20 to 25% on a credit card, 15% on a personal loan, where you can get an equity loan for, let's say, under 10%. Just the savings there in interest, if you have the equity in your home, that's where I see a lot of members taking advantage of the equity loan compared to the HELOC, like we talked about, variable for the life of the line. It does give you the flexibility though, because it is revolving, but getting into the variable aspect of the line, you have to really keep up with the market. Like John said, the US prime rate is the index for the home equity line of credit. So being able to kind of follow along with that to see what rates are doing, whereas the equity loan is fixed and it's locked in. So you're locked in for your 10, 15, or 20-year term.
Let me ask you this, Andy. So what if I got a HELOC, right? And then maybe for whatever reason, financial situation changes. Maybe I retire. Maybe I go from, my current income to more of a lower fixed income, right? And I really don't need an open line of credit. Can I make that into a home equity loan?
Yeah, so a unique feature of the home equity line of credit is the ability to convert a balance into a 10 or 15-year home equity loan. We only offer this one time during the life of the HELOC, so you can't continuously convert balances. I would say it's on the newer side, maybe 5-6 years that we've been offering this compared to how long we've been offering equity at the credit union. But, what I see people utilizing this for is, let's say they get the HELOC, they're going through the home improvements. It takes a year. Like John said, it could take a while. It could be expensive. So they like to have that flexibility, draw as needed materials, paying the contractors. Work is done. It's been a year. You're, sitting in your brand new living room, looking at your kitchen with your granite countertops, and you think to yourself, I'm a little bit uneasy about the variable aspect of the line. I don't need any more funds. We only did this for our improvement projects. I want to convert this balance. So then, our members will call in, we'll put them in touch with our mortgage servicing department to go over the 10 and 15-year options at that time. And then rather than going through the approval process again, our servicing department will make that adjustment. You'll sign additional documents, but you're able to then just convert whatever your balance is, or a portion of your balance, it doesn't have to be the full thing, to a loan. So like, let's just say, for example, someone had an equity line for $100,000, utilized $75,000. They want to convert all 75. They say, that's it. I want to know what my payments are going to be on the fixed rate loan. We convert that balance. That was 75,000. It splits the product, let's say. Easy way to describe it. You have a fixed rate loan for 10 or 15 years for that 75,000 principal and interest payment. You're good to go. The remaining $25,000 limit on the equity line is still available for you to use. So it's kind of like having the best of both worlds, I would say, where you have a fixed rate, you have your set monthly payments, no need to worry, you know what your payments are going to be every month. But you also have 25,000 available for the remainder of that 10-year draw. So if you do need funds in the future, or now we want to do a bathroom, or we need to do this or pay for college, you have that available limit to be able to utilize, if needed. You don't need to draw any additional, but it's there if you need to.
That's great, especially for our HELOC product. It gives someone, kind of a comfortable security knowing that option is there for them.
Yes, it's nice to not be, on the hook for interest only unless you, apply for a different product and pay it in full.
All right, let's talk about qualifications. There are some minimum qualifications for a HELOC. First one up is your FICO, your credit score. We have a minimum credit score requirement of 680, and that will enable you to lend up to 80% of the property value. Now, if your FICO is a little bit better, let's say 720, you can lend up to 90% of the property value.
And one thing I wanted to point out is for our equity applications, we only pull from Experian. We don't pull all three credit bureaus like a first mortgage. So for the home equity, pull from Experian. That's the score that we will use. So we're not pulling Equifax, we're not pulling TransUnion. Whatever your Experian score is showing, that would be the driving factor for your FICO score.
What about investment properties?
No go. Not on a home equity product with Patelco. That's more of a niche product. I'm sure there are lenders out there that do it. But as far as our home equity products specific to a primary residence or a second/vacation home.
That's good to know. Now, there's also some income verification. This is how we calculate debt to income ratios. And that's basically shows the underwriters basically that you could support the payment of a new HELOC. Let's get into that a little bit deeper with another video.
Sounds good.
Thinking about tapping into your home's equity? Let's make sure your HELOC application is as smooth as your morning coffee. First up, do gather all your paperwork. Your home loan consultant will have a list for you. Think of it like prepping for a bake-off. Organization is your secret ingredient. And do stay on top of payments. Even if your credit's been checked, lenders might peek again before closing. Keep everything current and shiny. Major life changes on the horizon? Switching jobs, vacation plans, or a relationship status update? Let's chat before you shake things up. And patience, my friend. Hold off on that new couch or shiny car until after closing. Big buys can tip the scales. Now let's talk don'ts. Don't apply for any new credit cards or loans. This can cause issues with approvals. Seriously, save the celebration until after closing. Don't start any major construction or remodel just yet. An appraisal might be needed, and a torn-up kitchen is not going to help. And of course, don't skip out on bills. Late payments could spike your risk profile faster than you can say interest rate. Quick recap, stay organized, communicate changes, and put a freeze on all big moves, financial or otherwise, until you open your new credit line. HELOC Hero status, fully unlocked.
All right, so kind of like the video is going over in brief details, do's and don'ts. Let's say we're paying off bills with the equity line or even the equity loan. We want to make sure that you're continuing to pay those bills on time. Just because we're paying it off doesn't mean, oh, I'm good, they're taking care of it, because the process does take some time, to go through, to get the approval, sign your loan documents with the notary, things of that nature. So just making sure you're paying your bills on time, and then letting us know as a loan consultant or letting the team know at Patelco if there's anything coming up, because like I said, the process can take some time. So if you're going on that vacation, you have maternity leave coming up, a variety of different things, retiring, you're, putting in your 2 weeks and going to into another position, whether it's in the same line of work or not. There's just a lot of things that can change. And if you have the control over the change, just to have that open communication with your loan consultant is just going to help make for a smooth process and not have any surprises down the line of the application process.
Absolutely. Anything that could possibly affect your income, we definitely want to know about, and definitely talk to us before. And like the video said, don't apply for any other new loans, mortgages especially, or anything that could affect what your monthly income is, or what your monthly debt is, I should say. And if you aren't able to start and finish quickly, let the loan consultant know, because we are required to, let you know yes or no within 30 days. And if you're going to be on vacation for 2 to 3 weeks out of those 30 days, it's really important to let us know.
Well, just the needing of documents too. If I'm in Hawaii for 2 weeks, I'm not sending documents. I know that about myself. So I want to apply when I have the amount of time or when I get back. So, just to plan that out, but to have that open communication with your consultant to kind of understand what is going to be the best way to move forward.
And plan ahead is so important. It's all about timing at a lot of times.
Yeah.
And very key thing is, before you even start planning a construction, a remodel, any type of home improvement, I would highly recommend, if you plan on using your HELOC for it, get the HELOC first. Again, there's no annual fee, so it's not going to cost you anything. If the loan amount's below $250,000, it's not going to cost you anything. Get pre-qualified. Don't start any construction on your home. We may need to appraise your home depending on certain situations. And if that home is all torn up and not in a livable condition, we're not going to be able to get a valuation. And you know what? You're not going to get a loan approval. So don't start construction first. Get approved for your financing ahead of time.
Yeah, absolutely. And like John was talking about costs, Patelco covers all customary closing costs on our equity products of $250,000 or less. So there's different cutoffs as far as where I see applications coming in for the limits that people are seeking. Let's say on a HELOC specifically, $250,000 or less, all customary fees are paid. Things come up from time to time. Changes to the title of the home, adding or removing someone, a name change, someone got married, solar panels on the home that resulted in a solar lien, solar financing, things like that come up from time to time. So there could be third-party fees, but all the customary fees are paid by us. And then over $250,000, our members pay the fees. So that's kind of a cutoff, when you have that conversation with your consultant to kind of go over what your immediate need is. If you need more than $250,000, totally fine. But just have that conversation, because once we go up to $400,000, there are all those fees that come with a line over $250,000 up to $400,000, but still no full appraisal requirement. The full appraisal kicks in at lines over $400,000 up to $500,000. Those can be quite expensive as well. Could range $700, $800, $900, just depending on the county, the estimated property value, the type of property. So having the upfront conversation to better understand what your needs are, to understand if $250,000 will work, because why pay closing costs if you don't have to? Or if you need more than that, then it can be structured, with your loan consultant.
Can you ballpark me, for, what are the closing costs for, let's say, a $400,000 HELOC?
I would say plan for $1,500 to $1,800 is what that would entail. There's title fees, escrow fees, doc prep fees, Patelco's lender fee, things, it all adds up. But that's why, you could save yourself that money at $250,000. But once you kind of settle on that number, we would do an application. We would send you a loan estimate so you can see everything up front before going through the process in its entirety.
Makes sense. All right, so let's find out how much we can borrow. That's going to be based on the combined loan to value. For most cases, what we're looking for is we're looking to allow to lend up to 80% of the property value. And that's with, again, FICO's about from 680 to 719. And then we can go as high as 90% of property value for people with FICO scores above 720. And here's a sample calculation. Let's say your appraised home value is 800,000, right? And the max combined loan to value of 80% is 640. Subtracting, let's say hypothetically, you had a first mortgage of 500,000. That will leave an available HELOC, line that could be about 140,000.
Yeah, and I would suggest to, instead of looking at potentially, let's say Zillow or an online evaluation tool, maybe speaking with a friend or someone in the real estate business, as far as a real estate agent, to be able to better understand what the value of your home is, because that would give you a good jumping off point, and you can really calculate this yourself before applying to, okay, I think my credit score is this, my real estate agent told me that my value is around here, so let me take that value, multiply it by 80% in this scenario, subtract what I owe on my first mortgage, and that's what's available, on that home equity line of credit.
Nice to have friends in the industry, Andy.
There we go.
All right, let's talk more about debt to income ratios.
Imagine unlocking your home's equity, but there's one key number lenders check: your debt to income ratio, or DTI. DTI measures how much of your monthly income goes toward debt payments, including mortgages, credit cards, car loans, and HELOCs. To calculate DTI, add all monthly debt payments, including the new HELOC. Divide by your gross income, then multiply by 100 to get a percentage. For example, if your debts total $2,000 and your income is $4,500, your DTI is about 44%. That's just under the 45% cap for HELOC approval. Increasing your HELOC amount raises monthly payments. If debts grow to $2,300 with the same income, DTI rises to over 51%, surpassing the lender's limit. Stay below 45% DTI for HELOC approval. Understanding your DTI gives you confidence and control over your borrowing decisions.
And so, everyone knows their finances better than Patelco does initially. You understand, what credit cards you have, what your auto loan looks like, what your mortgage payment is. So, just example of debts, that we're looking at when your credit's pulled, like I mentioned through Experian, you'll be looking at the principal and interest on your mortgage, the property taxes, the homeowner's insurance. So, you see that PITI, principal, interest, taxes, insurance. The payment.
That's what it stands for.
There we go. Yes, there we go. The payment on the HELOC, because you have access to the full funds, we want to make sure that you have an ability to repay according to your existing liabilities, as well as the new HELOC payment. Like you can see, credit cards, car loans, student loans, things that will show on the credit, alimony, child support, we see that as well.
So pretty much any type of monthly debt you have is going to be calculated into your total monthly debt. And then on the other side, we have gross monthly income. And that can include your W-2 wages, any bonus, commissions, overtime, etc. If you have rental income, retirement income, or possibly self-employment income.
And there's a lot of sources of income. We understand we can't fit it all in one slide. So, when you talk to the consultant, to be able to outline, the type of income you're receiving, so they can better inform you on, yes, that's something we can use to qualify, and these are the documents that we need to be able to verify that income.
Now, here's another sample calculation. Let's say your existing mortgage is about $1,800. Then you have some car loan and the credit cards. Let's say that monthly debt is $400. And then you're looking, I just need a small HELOC, maybe about $30,000. And, my proposed HELOC payment is going to be roughly about $300, right? So adding all those up, you get a total debt of about $2,500. And then I calculate my gross monthly income. Let's say that's $6,000 a month. So my resulting DTI is $2,500 divided by 6,000. Then changing it to a percentage is 41.7%.
And then one thing I wanted to point out, which is big for qualifying, if we're paying off any debt with the proceeds of the line of credit, we're going to omit that payment from your total liabilities, because we're already counting the payment on the home equity line as a liability against you. So we're not going to hit you twice. We're paying it to a zero balance. So that's just going to help your debt to income ratio to make it easier to qualify.
So what you're saying here is on the screen, you'll see that $400 is for a credit card or car loans and credit cards. That can be rolled right into your HELOC.
And zero that out. If that's the scenario, then we'd zero that out. Debt to income ratio would be, under 40%. So it just, helps people who are paying off debt make it that much easier to qualify. And simple, eligible properties that we have here: single family residence, 1 to 4 units, townhouse, like we mentioned. No rental properties, not something that we are currently offering. You can see vacation second home listed on there as well. So it's primary or a vacation/second home.
Remember, key points is that when you get a HELOC, your home is being used as collateral. There is a variable rate risk because of the U.S. prime could go up and could go down, which makes it for sometimes it can be unpredictable payments. Okay. So we definitely want to emphasize responsible spending. Just because you got qualified for a $100,000 loan, Andy, don't spend it all in one place.
Don't just write one check. Yeah, just, we are there to support you. We as loan consultants want to make sure, we're putting you in a position to succeed. We have other avenues within the credit union as well, certified financial specialists. We have a great retail banking side, that you can set up appointments with as well, our investment team, so lots of different services to utilize.
The key benefits, again, is flexibility. You pay interest on only what you borrow. Also, the rates are much lower. Lower because, we're using your home as collateral. And then potential tax benefits. Again, if this is a home improvement, if you're using a HELOC for home improvement, consult with your tax advisor to see if that interest can be tax deductible. And last but not least, you do get 0.5% off your rate if you set up automatic payments through a Patelco checking account that has a recurring deposits or basically direct deposits of $500 or more. So you get that checking account set up and have automatic payments set up, 0.5% off your rate.
And another thing I want to point out, the $500 recurring deposit, it doesn't need to be in one foul swoop. You can, have $200 coming in, on the 5th of a month, you can walk in, deposit cash, you can have a check. So it's not that we need all $500 in one deposit. It can be generated throughout the entire month. And then the intro rate that we discussed, we have less than a week. You just need the application to be submitted by the 31st of March. It doesn't need to go through the process in its entirety.
That's 6 days away.
But yes, it's coming up. We've been running the promotion since early mid-February. So we've seen a lot of applications and members taking advantage of this low APR, especially for members that potentially have a immediate need for their HELOC or transferring a balance over from another bank or credit union. So might as well take advantage of it for the first 6 billing cycles. But it is there. Feel free to give us a call, apply online. If you want to go into the branch, you can, your local branch, you can always, walk in and get an application submitted by the 31st.
Okay. All right, everyone. Thank you so much for joining us. Now we're going to leave some room for question and answers. Someone might have a question out there. What do you think?
See. I don't know. Maybe 1, maybe 2.
We got quite a few questions for you guys. Also, John, I want to wish you the best of luck in getting your midlife crisis motorcycle. A couple years ago, my mom got a red convertible Chrysler Sebring, and it was we called it her budget midlife crisis car. So, best of luck to you on that journey.
Yeah.
All right.
Responsible spending there.
The first question that we got, I know that you cannot do a HELOC on an investment property, but someone was wondering if it's commonplace to use your HELOC from your primary residence to purchase a second home or to purchase an investment property.
And yeah, I do see that, from time to time. We just need to make sure you're not under contract. This is not a bridge loan where you can go ahead and fund this equity line as you're processing, you're under contract for this investment property. We want you to be able to qualify based on your immediate needs and your qualifications. Once you fund that equity line, you have access to those funds. You can go ahead and utilize that equity line. You have a $250,000 limit. you can go ahead and, withdraw funds, wire it, at any time, to help for that down payment for that investment property. So yes, you would be able to use the HELOC to purchase or have a down payment for a future investment property.
Very nice. And then there were a couple questions that popped up in the Q&A about just kind of the interest side of it. I know when you were talking about making the interest-only payments, a lot of the Q&A lit up right there. So if you could just take another minute or two to kind of explain the interest payment only, or I guess the interest-only payments on the draw period. I guess the main kind of questions that were coming up was, if a HELOC has an interest-only draw period, how does interest work once people start paying principal? Does paying the principal change how the interest is calculated? If you could just dive a little bit deeper into the interest payments as well.
Sure. So the interest is accrued daily. So you have that interest. If you have a balance, it is accruing daily. And we do bill you interest only based on your outstanding balance. So you have the opportunity to pay additional towards your principal balance. And let's say, your HELOC balance is $50,000. You receive a monthly payment. I don't know what that calculation is depending on your specific qualifications, but you'll get a bill. It will show you your balance is $50,000. Your minimum monthly payment is X dollar amount. And it will show you also your rate, your limit on the HELOC. If you just pay your interest only payment and rates do not change, you do not add anything additional towards, let's say principal or purchases, then you're going to continue to carry that same balance and your payment is going to be, almost identical depending on the month. But for example, if you apply, you have your minimum interest only payment, you pay $1,000 on top of it for your principal payment. Next month, you make no additional purchases out of the equity line. Your balance is $49,000. Your payment is then going to be lower if rates did not change because your principal balance is lower. So that's kind of how it works. It's similar to a credit card, but not identical. But you will have a minimum payment. But as you pay down the principal, your payment should be less as long as interest rates don't increase. So that's kind of how it works in regards to the draw period and what you are billed by Patelco, and then you control anything that you want to pay on top of the interest.
So it's important to know that if you, for example, take a $50,000 HELOC and spend all $50,000, so to speak, and you're maxed out, and you're just making the interest-only payment, right, for let's say 10 years hypothetically, right? And then you hit the 15-year repayment period. Then your principal will go up higher. Your payment will go up higher because you're making both principal and interest, okay? So we highly recommend, and we see that most of our members with HELOCs do pay extra to principal every month. So it lowers the minimum payment each month afterwards.
And it's a lot of times also, if let's say you're consolidating debt, you're paying credit cards at 25%, the interest only on the HELOC could potentially be lower than what you were already paying. So it does make sense if you have had on-time payments and a great credit history, and you can make that dollar amount, might as well make the interest only, and then whatever you were making before, just go ahead and apply to principal if you can. Some months might be easier than others, but it really gives you the control of how you are paying down the equity line, but you do have access to pay additional towards principal at any time without penalty.
There's never a prepayment penalty.
Awesome. Thank you, guys. There was a question that popped up about the interest being tax deductible. I know, John, you mentioned that it can be, but again, just want to reiterate, everyone's situation there is unique. So if that's something you have additional questions for, just consult a tax advisor. They'll be able to point you in your specific situation a little bit better than we can. So there was another question that popped up. Is an appraisal always necessary when applying for a HELOC? And where else can you perhaps find the accepted appraised home value if you're not going to go through the process of getting a full appraisal?
So what happens on our home equity products? Appraisal is always required for over $400,000. Our max HELOC is $500,000. So anything over that is a full appraisal requirement. So $400,001 up to $500,000. What happens when you apply for a HELOC less than $400,000 or up to $400,000? The property address will go through basically a system generated appraisal. It's done electronically, So no one actually visits your property. It's not done by a licensed real estate appraiser, but it will give us a value, and we usually get that back right away. So then we can share this report with you. We can tell you exactly what value we are coming up with based on the system generated appraisal, but we can't tell you that before because it's built in to the online application. Once it's submitted, then it runs through this generated quote unquote appraisal, and we're given that value. So you always have the opportunity to upgrade to a full appraisal at full cost to you, the member. But hopefully with the value that we're getting through our system, no appraisal would be needed. You qualify based on the system generated appraisal that is distributed, once we have that application completed, and you're good to go. But the only requirement would be over 400,000. We would absolutely need a full appraisal every time.
Beautiful. A member asked, if I open a HELOC and don't use it for a few years, or if I don't even ever use it, are there any penalties or fees or issues with just having the HELOC open as a safety net and not even touching it during the drop period?
There are no annual fees, no prepayment penalty, no early closure fee. The only thing that in that scenario is once the account is closed and the lien is released, there is a reconveyance fee. Not something that Patelco controls. So that would be something that the member would have to pay. I would say plan on that fee being between $130 to $150. Things could change. That's what they are ranging from today, depending on the county. That's where I see the fee. But for, you keep it open for 10 years, you don't have any payments to Patelco if you don't utilize that equity line. You're not required to, no minimum balance requirement. So you can have it as a safety net. If things come up, like we said, you never know what's going to happen. So it's nice to have it available. But no, if you do not utilize the funds, no harm, no foul.
And these for loan amounts of $250,000 and less.
Okay, good to know. Somebody asked if there is a way to have a fixed rate on a HELOC, if there's a way you can opt into that, or a longer draw period than just the 10-year time period with the Patelco HELOC.
We do not offer that currently. Let's start with the draw period. Always 10 for a standard HELOC. So that's something that we cannot extend. We would have to reapply, go through the approval process again. The first part of it was a fixed HELOC. It's not something that we offer. The only things that come up from time to time, which coincidentally, currently we have the 5.49% promo. That is something that is going to be fixed. That we're just set for 6 billing cycles. So the first 6 billing cycles, that would be a time when it's fixed. But in reality, it reverts back to the standard qualifying rate, which would be variable for the life of the line. So Patelco doesn't have a true product that is a fixed HELOC.
Okay, beautiful. A couple questions just popped up. If the title is in a living trust, does that change anything as far as getting a HELOC going?
As long as the trust is revocable.
Yeah.
We wouldn't be able to do anything if it was an irrevocable trust.
Okay.
A revocable trust, totally fine. We would get most likely just one additional document from you, a trust certification that we would be able to send to you. You would complete it and send it back to Patelco. But yeah, as long as the trust is revocable, then you would be okay.
Okay, beautiful. I have one last question I will ask here before we wrap up this, and it might be hopefully not too long-winded one. But someone popped in, what happens if something happens to the title holder? Perhaps they pass away before the HELOC is passed off, or before the HELOC is paid off, I'm sorry. Is there any other insurance or anything available on the loan, or what happens in that situation?
Well, it is a lien on a home. And we will by there's a regulation called successor of interest. So whomever the successor of interest is, let me give you an example. Let's say a child inherits a home or goes through probate and becomes, basically gains control of the home. Even though they're not on the mortgage or any mortgage, they can be considered something called a successor of interest. Okay, and then that person is in a very unique situation. It's more of a loan servicing question, but they're in a unique situation where they're not legally responsible for the loan, but to prevent foreclosure, they can, as long as they're legally deemed successor of interest, they can continue making payments updating the insurance and so forth, and have all the privileges of the person on the loan, and not be their credit will not be affected if they default. But when worst case scenarios happen and foreclosures happen, it won't affect their credit. But if they need to have control to make payments and be sure a foreclosure does not happen, yes, the successor of interest will have the ability to do so.
And we can get you in contact with our mortgage servicing department, because that's something that they more so deal with on a case-to-case basis. So we can get definitely more specifics if you wanted to go into more detail about that question.
Awesome. Well, thank you guys both so much. I learned a lot just by sitting here and listening to you guys as well. For those whose questions we did not get a chance to answer this evening, we have it on the screen here, the email mortgagelending@patelco.org, as well as the phone number here with the extension 1202. That will take you to our mortgage queue. So you can please send your questions over. We're happy to answer any questions as well. John, Andy, thank you both so much for your assistance this evening and for your knowledge. We also do have a survey that's going to pop up here as soon as I close the webinar. For those of you who are joining us, if you would not mind taking just a second or two to fill that out, helps us quite a bit when building these webinars in the future and learning what we can do better moving forward. So I would greatly appreciate that. Otherwise, John, Andy, again, thank you both so much. I appreciate it.
It was fun.
Thanks for having us.
Have a good one. Have a good night, everybody. Hey, you guys, hope you liked that video. Thank you for watching. For more financial wellness information, go ahead and click here to subscribe and here to watch the next video. Thank you.